At U.S. inflation, despite rate hikes, the U.S. Consumer Price Index has risen. It's gone above the expected level in September and has come in at 8.2% on a year-on-year basis versus the estimated 8.1%. If you look at it on a month-on-month basis, the print has come in at 0.4%, and this against the estimate of 0.2%. So the 8.2% figure is off the peak of around 9% that was reported in June, but it still hovers near the highest levels in over 4 decades, especially core inflation, which has come in at 0.6%, which is now at a 40-year high. Meanwhile, you also have the jobless data numbers for the week. So jobless claims have increased. They've gone up to 228,000 in the last week compared to the 225,000 that was estimated. So in a statement that we got from the U.S. President Joe Biden, he has said that although work has been done to control inflation, prices are still too high. Well, he couldn't have said it any more clearly. José Torres is senior economist at Interactive Brokers, and he's joining us on this discussion about the inflation print that we've got. José, I mean, does this really mean, what's your takeaway from the number that is getting reported? Does it really mean that rate hikes haven't worked?
Good evening, Vikram. Thanks for having me. I think rate hikes are working. It just takes a while for it to filter through the entire economy. It works on a lag effect. And what we're learning is that inflation is tough to remove once it's entrenched in the economy, especially core inflation. Core inflation has accelerated last month, which is problematic for the Fed because these are sticky categories that are driven by a tight labor market with rising wages and also by rents, which are also rising. And it's very difficult once those price increases are registered to take them back. Like it's difficult to give a whole bunch of workers raises and then have them have pay cuts. Same way it's difficult for landlords to expect less rent in the future. So these are these sticky categories that the Fed is really concerned about, especially for inflation expectations. We've seen yields rise significantly, the 10-year above 4% and the 2-year above 4.5%, important resistant levels. And on the equity front, we're also seeing some significant weakness because we know that higher rates are bad for long duration assets. And it's been a long time since we've faced this level of Fed tightening and a few decades since we've faced an inflationary episode. And never have we seen the CPI above 5%, and we've avoided a recession.
That's right. So now what would be the Fed's alternative? Do you think they are going to get more aggressive than they've already been?
Yes. As of this morning, the market is expecting the Fed to not only deliver a 75 basis point rate hike in the November meeting, but also at the December meeting. And the terminal rate also rose from 4.63% to 4.88% for next year. So expectations are ratcheting it up. My concern is that elevated credit card spending and the tight labor market continues to pressure these core categories and makes the Fed go even higher than that. And that would be problematic for assets.
So then this is going to weigh in on investor sentiment on Wall Street. How do you see this impacting the equity markets for the inflation print that we are seeing and the prospects of the Fed getting more aggressive with those interest rate hikes?
Well, I think that things are getting very interesting here. When you have volatility and we have all assets go down, you can start to see some opportunity as a stock picker or as a bond picker. Defensive still appeal, the staples, the utilities, and healthcare. Then also you're starting to see some significant value in industrials and in energy. Some of the growth sectors one has to avoid because one doesn't know when the Fed is going to pivot. And after this morning's report, it doesn't look like they're going to pivot anytime soon. And what they've been saying is that they're going to keep rates higher for a long period of time, which means that one has to stick more defensive and more value rather than cyclical and growth.
We've heard the Bank of England announce this big bond buying program, and they are coming to the rescue as far as the financial system in the UK is concerned. Do you see more of this taking place because of the surge in the kind of yields that we've seen, or is this just a British phenomenon, at least as of now?
As of now, it's a British phenomenon, but I do expect in the coming months, central banks to deal with the offsetting factors of fighting inflation on one side and achieving financial stability on the other. And those are problematic offsetting conflicts. So we'll see. Here in the US, it looks like the Fed is significantly focused on relieving price pressures rather than being too concerned over financial stability. They still think that there's a lot of liquidity in the market. So they also recognize, Powell recognizes that the policies of the past did contribute to high inflation. So I think they're going to be a little tougher than some of the other global central banks.
And Jose, how will crude prices determine the severity of the oncoming recession? On the production cut so far, the International Energy Agency has predicted it is going to tip the world into recession. Would you agree?
Yes, because I think that tightening monetary policy this much in terms of rate hikes and balance sheet runoff all around the world, combined with high oil prices, it's too much of a shock. And we're moving from a world where liquidity was abundant and rates were low into a world where liquidity is scarce and rates are high. So it's a significant shift. And according to the US Treasury yield curve, the yield curve is implying that there's no way that the US can withstand this level of monetary policy tightening. On the other hand, high oil prices driven by tight supplies, geopolitical tensions, OPEC reducing supply, oil prices can still go higher from here. It's not winter yet. So I do think that risks are skewed to the upside.
How much further do you see the dollar index rising from here, Jose? And what's the kind of impact that you see on account of that on the emerging markets like India?
Well, I think that the dollar index can probably rise another 5 to 10% because all this tightening is making capital flows into developed markets where you have a higher risk-free rate. And I do see it weighing on emerging markets. Every time the dollar has been this strong, Vikram, we've seen some kind of weakness around the world, whether it was the Mexican and Latin American debt crises or the Asian debt crises or the Plaza Accord in the 80s. Every time the dollar has been this strong, even the Euro debt crisis in 2009, when you have a strong dollar, you have crises around the world. It's too much tightening, commodity prices too high, specifically oil, and it's going to be very challenging for the world to go through this. Too many shocks.
You go, Jose. The International Monetary Fund, while presenting the Global Financial Stability Report, has said that the worst is yet to come. What's your reading of it?
Well, I do tend to agree because, like I said earlier, Vikram, the rate hikes take a while to manifest and to work themselves through the economy. So we're seeing, for example, in real estate, there's no buyers in sight in the US and many other developed markets. No one can afford homes anymore with rates this high. That's what we're finding out. Manufacturing also weakening significantly, hovering in and out of contraction territory in new orders. So those tend to lead. We haven't seen the lagging indicators like employment or unemployment weaken. And I don't anticipate that this recession is going to be characterized by significant unemployment. I think this recession is going to be characterized by affordability pressures, asset value depreciation, and business investment decline, not significant unemployment. So while we're used to seeing recessions, and like in the movies, like in the Great Depression, where you see folks standing outside of businesses waiting for a job, I don't think we're going to see that this time around. Demographic factors are supportive of a tight labor market, and we have labor shortages at the moment, even though output has been negative in the first 2 quarters of 2022.
The scenario is rather bleak at this point in time, I'm afraid to say. Jose Torres, thank you very much for joining us with your perspective. We'll keep coming back to you for further perspective on the situation as it develops. Meanwhile, the high inflation